Retirement income usually gets plenty of attention before someone stops working. Social Security, investments, your taxes, your withdrawal rates from the portfolio, all these pieces tend to get reviewed and analyzed. When people retire at, let's say, 60 or 62 or 64, they can suddenly get hit with a problem maybe they never saw coming because they were so focused on this, but failed to look at this. So, what is this? It is understanding your options for health insurance before Medicare, which is usually available at age 65. Now, I'm not talking about a small inconvenience. I've seen retirees spend thousands, potentially even tens of thousands or more than necessary because of one mistake made during these years before Medicare eligibility. And what makes it even more frustrating is that the same strategy that saves one retiree money could cost another retiree a fortune. So in this video, I'm going to show you how to bridge the insurance gap before age 65 without blowing up your retirement plan, without triggering unnecessary healthcare costs, or creating tax problems that could follow you for years into the future. Hi, I'm Chris Knight with Cornerstone Wealth Planning, and we help people approach retirement and connect the dots between Social Security, taxes, investments, healthcare, estate planning, and retirement income, all into one coordinated, cohesive, integrated strategy. If at any point during this video you'd like help evaluating your own healthcare decisions and how it fits into your retirement plan, there's a link in the description where you can schedule a free call with our team. Okay, let's start with the real health insurance challenge. The first thing most people misunderstand is simply this. The challenge before Medicare isn't simply paying for health insurance. It's actually managing your income. That can sound very strange at first. After all, you've retired, so you're not really working anymore and thinking about income the same way. So shouldn't lower income automatically mean lower costs? Well, not necessarily. The ACA marketplace, it actually doesn't look at your assets overall, but it does look at your income. In technical terms, your modified adjusted gross income. So in other words, you could have $2 million invested or even more, but if your taxable income is managed correctly, modified adjusted gross income or MAGI, you may qualify for significant premium assistance. Now, on the other hand, someone with far less wealth could end up paying substantially more if their income isn't reported efficiently. And that's why the years before Medicare are often some of the most valuable tax planning years of your entire retirement. And that brings us to the first major strategy. Number one, control your modified adjusted gross income. So a mistake that a lot of retirees make is that they focus entirely on how much money they're spending instead of where that money is coming from and how it impacts the tax return. Now, let's say you need $80,000 a year for spending. Most retirees would sort of stop there. But the better question is, if you need $80,000 and you're before Medicare, then which accounts provide that $80,000 in the most tax efficient manner? Because every account has different tax consequences. If you take money from the checking account and savings account, there's potentially little or no impact on the overall income. If you draw it out from a taxable brokerage account, then it depends on the overall gains, capital gains. Traditional IRAs, generally that shows up on the tax return as fully taxable. Roth accounts, most likely that's tax-free cash flow or income. So where the money comes from really changes everything. And I've seen retirees with identical spending plans end up with completely different healthcare costs simply because they use different withdrawal strategies for their spending needs that impacted the tax return in different ways. So that's exactly why we help clients build retirement income plans that coordinate withdrawals, taxes, and healthcare planning together into one plan, integrated and cohesive, not separately. But things get really interesting when we look at something like the Roth conversion trap. Now, before anyone gets the wrong idea, I certainly like Roth conversions. We use them very frequently with clients, but the context here really matters. And a Roth conversion is not automatically a good idea every year, especially before Medicare. And now here's why. When you convert money from a traditional IRA into a Roth account, you do create income on the tax return that will impact that MAGI, modified adjusted gross income. While you could be lowering your future taxes, you could also be increasing your ACA income and lowering the premium assistance that you could receive. So this would increase healthcare costs. It could obviously reduce premium assistance, and most likely it's doing a little bit of both. Now, I've seen retirees so focused on reducing this future income tax picture from the IRAs going to the Roth and hopefully lowering the required minimum distributions that they overlook what these conversions were doing to their healthcare costs today. So it's not really a question of whether to do Roth conversions. Really, it's a question of how much to convert without creating these unintended consequences. And that's one of the reasons that coordinated planning makes such a difference. Because taxes don't happen in a vacuum, and neither does healthcare. Everything is connected. So let's now talk about one of the most underrated strategies in early retirement, and this is to build flexibility. We call it building a cash reserve bridge. Now, a lot of retirees think that portfolio only exists to generate returns. There's another way to also think about this. Your portfolio should also provide you some flexibility and optionality, the ability to make smart decisions when opportunities show up. And that's where something like a cash reserve becomes so powerful. Let's say you're retired at age 62 and you need income, but you also want to keep this taxable income or MAGI calculation as low as possible for ACA purposes. So having cash reserves gives you choices. Instead of forcing taxable withdrawals every single year, you could pull from cash during certain years, manage your taxable income more efficiently, and create room for significant tax planning opportunities. So without being backed into a corner simply because you need the extra cash flow, this is very important to understand. And this can be similar to a two-bucket approach that we often use with many clients. One bucket funds near-term spending, while the other bucket funds longer-term growth goals. And that structure really creates both financial and emotional benefits because you're not constantly wondering where next month's income is coming from, but you're able to allow one bucket to provide your day-to-day needs near term, and then the other can stay invested for your long-term growth. So this structure can help, again, both on the financial and emotional benefit side. Now, if you're within 5 years of retirement, you're trying to figure out how healthcare, taxes, Social Security, and these withdrawals all fit together, there's a link in the description where you can schedule a free call with our team. Now, let's talk about why the years before age 65 are a massive planning opportunity. So the years between retirement and Medicare can actually be some of the most valuable planning years maybe that you'll ever have. So think about what that could look like during this window. You have no paycheck, maybe you're delaying Social Security, your requirements for minimum distributions on your own accounts have not occurred yet, and potentially you could have lower taxable income than you've had in decades. Now, those conditions create real opportunities for tax planning, for strategic withdrawals, maybe some Roth conversion analysis should occur, and you could position yourself better for the decades ahead. Now, the problem is, most people only see healthcare during this window as an expense, but a well-coordinated plan could see it as part of a larger system. When you put the pieces together, the results could be dramatically different. So here's what I want you to take away from this video. Healthcare planning before age 65 isn't just a healthcare problem or question, it's a retirement planning problem. Because every decision touches another decision. Taking larger IRA withdrawals, doing these Roth conversions, or claiming Social Security, or if you need to sell investments from a brokerage account with capital gains, all of these have healthcare implications. So that's why a strong retirement plan will connect all these pieces into one clear picture. Looking again at what you own, what you owe, what income is coming in, what's going out, what is your income gap, and what tax bracket are you targeting, and how healthcare fits into all of that. And when you answer those questions together, then your retirement becomes much clearer. A lot of retirees think they need an investment plan, but all they actually need is a very clear retirement plan. They need an investment plan that focuses on growing money, but a retirement plan focuses on turning that lifetime of earnings, your money that you retire with, into a lifetime of confidence. And that's what these pre Medicare years are really all about. Not just finding health insurance, but creating a coordinated strategy that lets you retire confidently, minimize unnecessary cost, and keep more of what you've worked so hard to build. So if you'd like help with this, building a personalized retirement income, tax plan, healthcare, and Social Security strategy, I invite you to click the link in the description and schedule a free call with our team at Cornerstone Wealth Planning today, where we will help you connect all the moving pieces so that every part of your plan is working together correctly, not against each other. And so this is key to think about as you look forward, is to put together all the key pieces before age 65 if you're retiring and planning for health insurance. How do you mitigate the cost and maximize your overall returns in retirement? That's the key question, and we'd be glad to help. So thanks for watching, and I'll see you in the next video.